electronic screen, just like they do for foreign exchange or interest rates. The opaqueness is directly connected to the profitability of the banks, and it's directly connected to the risk of the system.
And most people don't realize how big the derivatives market is compared to the regular banking system. Could you give our viewers and listeners a sense of the proportionality we're talking about?
The notional value of derivatives by the top 25 banks is about $300 trillion. American GDP is $15 trillion. So I think that's roughly 20 times the size of the American economy. It is the biggest dimension of the balance sheets of all the major banks.
And it's largely unregulated.
And it's largely unregulated. And if they were going to tolerate these so-called end-user exemptions, they should pay a huge capital surcharge for the right to put the system at risk, and that's not what's happening.
Rob Johnson, I almost missed your testimony in October because I blinked, but you were the only industry expert who was invited to testify before the House Financial Services Committee on the derivatives market.
Right.
Talk about what happened in October.
What happened in October is that with about 14 hours to go, Americans for Financial Reform and other consumer groups and labor unions became upset. They didn't have anybody being represented with a point of view. Michael Greenberger, who's a greater expert than I am on this, was considered someone they wouldn't accept. I have worked both for the Republican and Democratic Party earlier in my career, so both parties would accept me. I came in, testified. Melissa Bean was in the chair, a congressperson from Illinois who's very friendly with the banks. And she gavelled down my opening statement. I asked if I could submit the rest for the record. And prior to the testimony, I said, I'd like to be able to put this in the record because you're asking me to testify on a 142-page bill with about 14 hours notice.
How much time did you speak?
14 hours. I spoke for about 4 minutes before I got cut off, after listening for an hour and a half to eight different industry group representatives. Subsequently, there was a rough and tumble, and eventually Barney Frank was cornered by the Christian Science Monitor and I believe Harper's Magazine in a press conference, and he said, mea culpa. He called me. I met with him, and he apologized, and he put things on the website and in the record.
So your entire testimony that you didn't get to give was put into the record?
Yes. It's available on their website from October 7th of 2009. It's there now.
It's easier to understand now, this issue of people not really understanding what's going on. Kai Wright, the significance of this and what is able to be gotten away with and who really gets hurt in the long run.
I mean, I think we can't underestimate the problem of it being so complicated on its it sounds complicated, right, when we start talking about it. But it's actually really quite simple. When I started reporting on the subprime crisis, what struck me probably the most was how unsurprised anybody who had been working in communities where all of this predatory lending had been taking place for 15 years.
What are those communities?
They're largely black and Latino communities, but they're working class communities all over the country. Places where we had run up, where credit card companies and payday lenders and the whole swarm, I would call it, of financial players had run up a bunch of debt and put people with their backs against the wall and left them vulnerable to these come-ons from mortgage brokers. Keep in mind again, that's something like 60% of subprime borrowers were steered into these loans. So the people who were working in these communities were not at all surprised when the world looked up and said, oh my God, we could have never seen this coming. They said, yeah, we could. We said it was coming. We told you it was coming. Here's the testimony that we gave to our state legislatures, the community advisory board of the Fed. Here's the testimony we gave to the Fed saying that this was going to be a problem. The problem is nobody acted. And nobody acted because it wasn't in anyone's interest to protect consumers. All of the existing regulators, their interest is in protecting the health of the banking sector. That doesn't mean they're bad people. Well, they may or may not be bad people. But their job is not protecting consumers. And so the goal here is to create something that actually protects consumers. And if that thing has to answer to the regulators who ignored all the people who were talking about this is a problem for consumers 10 years ago, then it's not going to do it. And that's simple. That's straightforward. People knew this was going to happen. They said it was going to happen. The people responsible for stopping it didn't do it. And now we're putting those same people in charge of stopping it again.
And Rob Johnson, in terms of warnings, the last couple of weeks, there have been a lot of the influential publications in the nation have been resurrecting the discussion about the dangers faced by the Social Security system. A front-page article in today's New York Times saying for the first time this year, it appears that Social Security will pay out more to recipients than it will be taking in. And they're claiming that the economic crisis, the number of people that are unemployed, are exacerbating the situation because there are not as many people paying into the system. Your sense, it appears that the Obama administration has been sending signals for quite a while that it intends to tackle the, quote, Social Security crisis. And I'm wondering your thoughts on that, the crisis and its relationship to the general economic crisis the country's facing.
Juan, you're right that a drumbeat is building. A bipartisan deficit reduction committee is building. I experience a great deal of outrage. For us to look at the debt growth from this banking crisis, what economists call the debt to GDP ratio, it's gone from about 40%, they predict it'll go to 85%, more than doubling. The deficit hawks, when we were doing bank bailouts, took a vacation underwater. They're now talking as though grandma in 2049 is risking our financial health. I don't see any of those same people on deck as deficit hawks saying we need financial reform of a really profound because we can't afford to go from 85 to 125% of GDP with our debt. And this stuff really does matter. It matters to roads, bridges, schools, senior aid, and health care. Just like the health care bill, which pads the profits for all of industry, then we'll complain that Medicare costs are out of control. It's not because grandma is consuming too much medicine. It's that we don't have a competitive system in health care provision, health care insurance, or in pharmaceuticals. This is a problem of governance. It is a problem mathematically, but the problem isn't with Social Security.
And yet, as we were talking before the show, Juan, we are seeing a drumbeat of newspaper articles. Now on television, you see all the pundits saying, have you seen Social Security? It looks like more is being paid out than we're taking in. The drumbeat is developing. Right.
And my question, obviously, as we've discussed this before, the idea that a particular part of government services is costing more. It's never, for instance, raised about the Defense Department. That the Defense Department is costing too much, and we need to cut back on defense spending.
Or that my alma mater, the hedge fund industry, pays 15% income taxes under what they call carry interest provisions rather than true income taxes. Warren Buffett even jokes about this. He says his income tax rate is lower than his secretary's.
If Bush's privatization of Social Security had gone through, would it have been wiped out in the financial crisis?
Well, it would have taken the same magnitude of losses that, say, the equity market did, so a substantial amount of losses, yes.
Lehman Brothers head Brian Marsaul was just in Berlin at a bankruptcy conference, and in an interview with a German business daily, he said that the Wall Street, that the banks are in for another mega bank bankruptcy. Is this true?
I don't think it's imminent, but I do think it's true. And where I think it's hidden right now is that you have a whole bunch of second mortgages and equity lines of credit that are embedded in the big banks that are being priced at about 85 cents on the dollar. They're probably worthless. But no one in the accounting profession or at the Treasury or the Fed is forcing these people to realize those losses. Now, what does that mean? If you overstate the value of your assets and you don't take your losses, then you can overstate your earnings and then you can pay big bonuses.
And Kai, finally, I'd like to ask you, what can the consumers who will be affected by this this new Consumer Protection Agency do now as this bill moves through the Senate?
Well, it's the same thing that all of us are going to have to do, which is continue to hold elected officials accountable. It's tough. We saw it for health care. We're seeing it now in financial reform. We'll probably see it when they get to immigration reform. It is difficult these days to get voters voices heard by their elected officials. And I think we have to do the same things we always have to do. We have to let them know we're out there. We have to let them know we're paying attention, and try to stop it. It's barreling ahead, and it's clear that they don't want to accept a whole lot of amendments. They want to get this thing passed fast.
And the banks are very happy. Is that right? I mean,
well, my colleague Mike Consul at the Roosevelt Institute put on the blog at New Deal 2.0 the other day, what would Goldman Sachs dislike about this? And the answer was nothing, really. And he did some research. He called people behind the scenes. They're not opposing this bill because there's nothing in it that takes a bite out of them.
Rob Johnson, we want to thank you for being with us. Rob Johnson's Director of Economic Policy Initiative at the new Franklin and Eleanor Roosevelt Institute, and Kai Wright, Editorial Director of Color Lines Magazine and a Fellow at the Nation Institute. Thank you both for being with us.